Today, we're going to analyze CMS Infosystem Limited's Quarter 2 fiscal year 2026 earnings plus their future outlook, growth outlook, basically. So let us start. Here we have a summary of the earnings, the main things. Revenue, EBITDA, that is earnings before interest, taxes, depreciation, and amortization, that is EBITDA, and profit after tax. All of these are in crores. So revenue declined from Quarter 2 fiscal year 2025 624 crores to 609 crores in Quarter 2 fiscal year 2026, a decline of 3% year on year in revenue. EBITDA declined from 156 crores 12 months back, that is Quarter 2 fiscal year 2025, to 139 crores, 11% decline. EBITDA margin declined from 25% to 22.8%. Profit after tax declined from 91 CR to 73 CR, declining the margin declining from 14.6% to 12%. Okay, now let us take a look at the financial performance segment wise. Okay, so the entire business is divided into two parts. One is cash, so cash logistics, literally transporting cash. Second is managed services or like solutions, managed services and tech solutions. The non-cash stuff like security solutions, kind of security solutions, basically cash and non-cash stuff. So the cash segment, the revenue, this is the blue one, okay? Revenues grew from 390 CR to 395 CR, while for the solutions business, the tech solutions business grew from 264 crores to 271. All right, both of them had moderate-ish growth. Then the earnings before interest and taxes, that is EBIT, okay? Cash declined from 97 CR to 59 CR. Massive decline in the margins, that is the profits of the cash segment, the cash business. While the MS and tech solutions business, only a slight decline from 40 CR to 38 CR. Okay. And here we have the EBIT margins. All right. 25% in cash 12 months ago to 14.9%, like EBIT margins this quarter. So massive decline, while the MS and Tech Solutions EBIT margins went from 15.1% to 14%, a slight decline. Now, impact on EBIT percentage in cash logistics is due to lower revenue, impacting network utilization and higher provisioning. Okay, what this simply means, from what I understand, there's a statement here. Phrase, higher provisioning. Provisioning means they had to set aside provisions. What are provisions? A fund set aside for a specific reason. So they had to set aside some money for specific reasons, and this money directly comes out of profits because it is basically an expense. This provision is an expense. Okay, around 10 CR this quarter, this provisioning. Then uh, lower network utilization, impacting network utilization, lower network utilization. CMS has a lot of ATMs, okay? But this quarter, many of the ATMs, as compared to earlier times, lower percentage of them could actually get utilized due to one big client having some problems. One big client has some problems, so lower percentage of ATMs were actually getting used, and expenses have to be made in order to maintain those ATMs. So expenses are going out in order to meet in order to maintain the ATMs, meet the requirements, repair and all of that. But the ATMs are not getting utilized as much as before. So that led to lower revenue coming in and costs still being there. So earnings declining a lot. Now, the updates. The H1, meaning first half, Quarter 1 plus Quarter 2 fiscal year 26 is H1. Business momentum remains robust. New order wins of 500 CR in Quarter 2. Order wins of 500 crores. Nice. Total wins 1000 crore in the first half. So Quarter 1 plus Quarter 2. Then they're expanding the direct to retail strategy. Direct to retail is kind of like cash business, but for retail, all right? Like literally transporting cash from like stores to maybe ATM stores to the bank, all of that. So the direct to retail strategy from e-commerce to BFSI, all right? They added 5,000 new retail points in the first half. Nice. Then their Hawk AI solution, which is kind of their remote monitoring service, tech solution, is being deployed at a quick commerce leader, expanding to 1,800 plus dark stores. And they converted a 100 crore fiscal year 2026 project revenue into a 225 crores long-term recurring revenue. All right. Now, why were margins impacted? We discussed this. Incremental provisioning of 10 crores as a prudent measure due to payment delays amid stress in the MSP ecosystem. All right, so they're going some payment delays. I guess clients are delaying some payments. Some payment delays are going on due to which they have to set aside money equal to around 10 crores this quarter. I believe this quarter. There were lower retail volumes driven by subdued consumption. So consumption was a bit subdued. That's why lower retail volumes and temporary dip in ATMs due to slower ATM deployments and a delayed SBI contracting process. All right, slower ATM deployments are going on, and something related with SBI got delayed. Now, thing is, CMS Infosystems has a lot of fixed costs. Okay, a lot of fixed costs. So, higher and higher revenue will lead to better margins because those fixed costs get divided more and more. I guess that is economics. So, yes, a lot of fixed costs are there, and higher revenue growth will lead to higher and higher margins. And that's why low revenue growth margins do get impacted. Then under mergers and acquisitions, the Securance acquisition has completed. I think this is some other company in the same ecosystem that CMS currently operates in, the same business segments. Securance, the acquisition has been completed. What is the outlook looking at for the second half of fiscal year 2026, H2? So quarter three and quarter four. So the ATM management solutions, one of the biggest segments, maybe their biggest segment, ATMs. Yeah, this is the biggest segment. So ATM management solutions is expected to return to a growth trajectory in H2. Expected to return to a growth trajectory in the second half and deliver double-digit growth in fiscal year 27. So this will be a recurring theme that they're coming to growth in the second half, but fiscal year 2026 is expected to be a soft year. Okay, keep that in mind. It's expected to be a soft year. Fiscal year 2027 will be the double digit, and after that. Okay, so SBI, yes, the cash outsourcing RFP, which is like a tender, it closed post extensive negotiations. So it has finally been closed. They have finally gotten an order from SBI for cash outsourcing, an incremental 500 crores opportunity for next 7 to 10 years. Have they got it? Close post extensive negotiations at contracting and final approval stages. All right, I think they have got it. Then the Hawk AI solution is scaling robustly with target expanding to 50,000 sites by fiscal year 26. And their overall target is 80,000 sites by fiscal year 2030. Hawkeye solutions to be deployed at these number of sites. And they're targeting to grow their services revenue. Now, this services revenue is their like cash logistics services, tech solution services. All of that is around 90% of the revenue. The last 10% is selling hardware. So the services revenue, around 90% of the total revenue, is expected to grow by 9% in the second half over the first half to regain growth momentum to build a strong base for fiscal year 2027. So you take how much revenue was made in the first half, you add around you take around 90% maybe of that, and you have a 9% growth over that for the second half of fiscal year 2026, and then returning to momentum in fiscal year 2027. And you can read all of this. Margin recovery driven by ATM deployments expected to be higher. Okay, expected to be around 75,000 by March 2026. They're targeting a 5% increase in ATM pricing, and they're going to be optimizing network routes, 10% reduction in number of routes, and a transition of 25% retail points to gig model. All right, so reducing some expenses, some operational efficiency expenses reduced. Okay, that sounds good. Now let's take a look at the overall outlook. Okay, outlook over a longer term, what they have given. So first is the ATM management solutions market. Okay, what is the outlook looking at? So fiscal year 2025, 1,300 crores were generated. Fiscal year 2026, very soft year, a soft year. Fiscal year 2027, 1,575 to 1,625 crores in revenue. Fiscal year 2030, 2,200 to 2,250 crores in revenue. Okay, 11% CAGR growth over the long term. That is what they're saying. They're saying increase in the interchange fee, pricing uplift potential. So even increasing the pricing, the fees from clients, the fee per client, they're thinking of increasing. Okay, they're targeting this increase, and the assumptions for the growth are that the overall ATM base is going to be around 250,000 to 275,000, out of which the number of outsourced ATMs outsourced by banks to like third party service providers like CMS. It's going to be around 1.2 lakh to 1.7 lakh, and CMS's market share is going to be 25 to 30%. So they're going to be catering 25 30% of these outsourced ATMs or total ATMs. Have they, for overall ATM platforms, excluding WLAs, white label ATM? Okay, this asterisk for overall ATM platform. What does that mean? Okay, okay. From overall, this one, I'm assuming this one. All right, I'm assuming this one for the overall ATM base, 25 to 30%. Okay. Then for the retail, okay, one was ATMs. ATMs usually, operated by banks. This for the retails like stores and all of that, managing cash flow and all of that. So 640 crores, increasing in the next 2 years to 725 and 50 crores. By 2030, 1,050 to 1,100. What are the assumptions? 2 lakhs to 3 lakhs touch points. Touch points, a number of points where customer interacts with the service. So touch points, literally kind of touching their service. Where can customers touch their service? 2 lakh to 3 lakh points. The assumptions by 2030, again 11% CAGR growth, and CMS market share, they're assuming it to be 38 to 43%. All right, and the drivers expanding the market beyond tier 2. Okay, banks consolidating currency, and retail, e-commerce, NBFC, and banks expanding their branches and stores. Okay, all right. Still 11% growth across two of these segments. Then comes the fast growing technology and payment solutions outlook. So I think they provide even payment solutions. That's interesting. But technology and payment solutions, 20% CAGR growth, 240 crores in fiscal year 25, increasing to 400 by fiscal year 27, to 500 to 600 CR by fiscal year 2030. What are the assumptions? The Vision AI, that is their remote monitoring kind of security surveillance solution, 30 to 80,000. Wait, 30 to 80,000? Oh, not 30 to 80,000, growing from 30,000 to 80,000. Okay. That bank one was also that. Okay, the bank one was also that. Okay, fine. 30 to 80,000, growing from 30 to 80,000. Their market share in the BFSI, like technology solutions market, 25 to 40%. Okay, number of ATMs growing from 68,000 to 100,000. Okay, this is Algo MS, this is payments card. Basically, it's a bit confusing, but high growth. There are a lot of assumptions going on, but overall, they're expecting higher growth from this segment. Yes. So overall, they're expecting a 12% increase in revenue in the total services revenue, which makes up 90% of the total revenue. All right. So fiscal year 2025, you plus all of these, you get 2,180 crores of services revenue and 2,700 to 2,800 crores of services revenue. Okay. Again, this is not total revenue. It's like 90% of the revenue, and increase to 3,750 to 3,950 crores in fiscal year 2030, around 12% CAGR growth. That is the main thing. And they have said rule of 35, revenue growth plus EBITDA margin should be more than 35%. All right. And one more thing they have said that we already saw they want to increase the services revenue from 2180 to around 3760 to 3950, right? If they add an acquisition, which they're aspiring for, their aspiration is if they have some more acquisitions, they can expand this growth to further 4500 crores to 4750 crores. So overall, they're expecting recovery, but all of these visions, they can seem a lot of assumption based. Of course, they have to be assumption based. So yeah, that is it. Overall, good double-digit growth is what they're expecting in the future. That is it. Bye. And recovery in the second half of fiscal year 2026, 9% growth in services revenue over the first half. So maybe you can calculate from that. You can see the first half services revenue from their earlier investor presentations. And then for the second half, 9% added to that. And let us see if they can actually achieve this future guidance. And for their margin recovery, the EBIT margin and profit after tax margin, if I remember, management has specified that they want their margins to return to normal times, normal figures, normal times, normal figures by the end of fiscal year 2026. So by end of fiscal year 2026, they want their margins to return to their old place. That is it. That is it. Bye.